Salut,
Salut Philippe.
tout bien?
Ouais, ça va bien ça?
Oui, très bien, merci.
Good, fait que la connexion s'est bien passée. Fait
Oui,
qu'on t'entend bien. Ouais, je pense comme la dernière fois, je t'introduce, puis après ça, on passe ça. T'as juste à faire attention, je sais que des fois, je sais pas si t'as un micro sur un casque ou si le micro est dans ton ordi, mais des fois on dirait que tu reculais puis on t'entendait moins.
oui, au début, c'est ça que j'ai vu le
Ouais.
commentaire. Donc là,
Ouais, ok, tu
je me
l'avais
suis
vu.
réaligné vers mon ordinateur. Là, donc, ça va être plus
Ok.
cette fois-ci.
Ok, parfait. Fait que bon, on se met sur mute, il y a déjà du monde connecté, on se met sur mute jusqu'à midi, puis à midi, je t'introduce.
OK, merci.
Ok, merci. Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We're pleased to welcome today Louis-Philippe Roy, Vice President at TD Asset Management, here to talk to us about their low volatility strategies, which are included in our new Smart Beta Plus portfolios. Please note that if there's enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Louis-Philippe, the floor is yours.
Thanks, Matthew. Do you understand me well, hear me well?
Yes.
Okay, perfect. So thanks, everyone, for joining me today to talk about low volatility strategies. The presentation will be separated into three sections. The first part, I will cover the firm and the team. The second part, the macroeconomic backdrop, because we think it's very important to understand the current investment environment that we are in order to properly choose your investment strategy. And finally, I'll talk about our low vol funds, certain characteristics, what you should expect, and the recent performance. So turning to page 2, TD Asset Management is one of the largest asset managers in Canada with about $390 billion. We cover all types of strategies now, from money market to alternatives, servicing both institutional and retail clients. Here's the next page. This is the specific asset under management of our low vol strategy. So this team is based in Montreal. We grew this from about 0 in 2009 to one of the largest franchises in Canada and around the world, involving this particular investment style. So we're managing close to $23.5 billion now across a multitude of regions, so U.S., emerging markets, global, Canadian, and finally all world. On page 4, there is a slide on our team. So managing global portfolios requires an extensive amount of data. So we have a data computation team on the left who's responsible for managing this data. So you can imagine hundreds of thousands of data points per day that need to be processed, cleaned, so that we can probably utilize them when managing our funds. We have a research and development team who's responsible for maintaining our current offering, improving our current offering, as well as building new strategies for our clients. And finally, the portfolio management team is a team that I'm part of, and we're responsible for the day-to-day management of the funds, any discretionary decisions that happen in the fund, the rebalancing of the funds, and general management of currency hedging. We are also, quite involved in speaking with clients, explaining the performance, and we're helped with by that with the client portfolio management team on the right. On page 5, we'll start off with the macroeconomic backdrop. So last year, for the past 12 months, a lot of focus has been on the Purchasing Manager Index, which is essentially an index from companies evaluating where they think, evaluating various questions. And on the manufacturing side, it's been a clear slowdown since 2017, and actually below 50 in Europe. So any number above 50 implies an expansionary period, and below 50 would imply contraction. So Eurozone manufacturing is essentially in contraction now, and we see a lot of numbers out of Germany being extremely weak. Europe is more linked to global trade wars. Most other regions around the world, so they're most heavily impacted by what's happening with Donald Trump's tariffs, imposing tariffs around the world. So it's been a clear drag on economic development. On the right is GDP growth rate. So what we see here is since the financial crisis, GDP has been across various regions, 1.5% to 3%. And over the past year or two, there's been a marked slowdown, but it's definitely not negative territory. So we're still anticipating the final 2019 numbers to be extremely weak, but not negative by any means. Turning to page 6, these are more focused numbers on the U.S. economy, but they're very similar to the Canadian economy. So the core PEC is essentially a measure of inflation. Inflation is essentially where the U.S. Fed wants it to be, around 2%, and Canada is around 2% as well. We got the CPI numbers yesterday, and pretty much where the Bank of Canada wants to be at 2%. In the U.S., and change in non-farm payrolls, so private payrolls, is strong, continues to be strong in the 200,000 to 300,000 range. Canadian employment parallels this. There's been a very, very strong Canadian employment numbers last year, and a lot of people are attributing this to immigration. Another reason why that's supporting house prices is a lot of immigration coming in, so more people. So Canada is actually one of the fastest growing, has one of the fastest growing populations in the G10 right now. And then along the same lines, unemployment very strong or very low in the U.S. and Canada. And finally, I'll look at the bottom. We'll skip to the bottom. The hourly earnings, so closer to 3% in the U.S. and I think 3.5% in Canada. So strong earnings growth. So we have these two different sets of data. So PMIs are very weak. The manufacturing sector is weak. The service sector in the U.S. and around the world is actually not doing that bad. And you also have these numbers here on page 6, which shows that the consumer sort of is doing okay in the sense that, you know, people who want to be employed are employed. They can find jobs. The point is also on this slide is these tend to be more backward-looking numbers, while PMIs tend to be more forward-looking numbers. So the central banks have, these two different sets of data to manage in order to set their interest rate policy. So if we turn to page 7, we saw a global, financial tightening since 2016. So we clearly see the U.S. Federal Reserve on the right, the light blue line, raising rates a number of times, followed by the Bank of Canada also raising rates consecutively. But over the past, 9 months, there's been a clear easing bias by the Federal Reserve and easing bias by the central bank. And the Bank of Canada being one of the only banks actually not in the process of cutting rates or introducing some type of easing. And the rationale behind the federal bank lowering rates is really the uncertainty around the trade wars, which did have a meaningful impact on the manufacturing sector in the U.S. And like it or not, they are influenced by markets, so they only cut rates after Q4 2018 when markets fell 20%. So they were getting cues from financial markets that interest rates were too high, and so they cut rates actually 3 times now, but look to be on hold for the rest of the year, according to various surveys. And the general consensus, the Bank of Canada had their first meeting yesterday, and they did not cut rates, and very few economists believe that they will cut rates this year, based on where inflation is. However, their tone was a lot more dovish, so the Canadian dollar definitely weakened on the news yesterday, and the longer-term rates fell as well. So they're more open to cutting rates than they were in previous meetings. So meaning that there's sort of a structural slowdown for the Canadian economy. When we look at the economic data, now we look at financial markets and where we are now on page 8. There's quite a big difference from let's say Q4 2018. So now interest rates are around in the U.S. about 1.8, 1.7% in Canada. So 10-year rates, long-term rates are quite low. They're actually even below inflation numbers. So at TD Asset Management right now, our view is to be underweight fixed income because you're getting negative real returns owning fixed income assets. It's not very interesting. When we're looking at the earnings yield on the chart on the right, this is the difference between the earnings yield and the 10-year yield. It's positive. So you're getting paid more to hold equities than you are to hold fixed income. The earning yield has fallen over the past few years, but still in positive territory. So our general view is that we are more bullish on, or we'd rather own equities than fixed income. And I'll come back to this slide a bit later. Now let's go back to school a bit and understand more about what we're trying to do and how we're trying to manage our Laval portfolios in these types of environments, and what you should expect from us. And so the first thing is on page 9 is when you lose 50%, you need to make 100% back to get back to where you were, to recoup your capital losses. When you lose 25, you need to make 33, 34%. So the smaller the loss, the smaller you actually need to get back in terms of returns to get back your capital. The other thing I would add is the sort of behavioral finance aspect. In 2008, when people lost 50%, a lot of people were saying, well, I took too much risk in my portfolio. I don't want to lose another 50%. I'm going to lower my asset allocation weight to equities and increase it to notes or fixed income or cash. So to make up their capital loss, it actually even takes a longer time because they want to de-risk their portfolio after huge losses. And so that's really, it plays a lot on the psychology when you lose that much of your portfolio. That's the first step to understand. The second point is on page 10. So in school, or generally in life, really, we learned that the more risk we take, the more returns we should expect. That makes common sense. Who would want to take more risk and expect less return? No one. And it's generally true across asset classes. So equities have delivered an equity risk premium over bonds. Equities have been more risky, but also delivered higher returns than fixed income assets. However, when you're looking at the data, it's absolutely not true. It's more of a flat line. So within the fixed income space, holding more credit, so more riskier bonds, hasn't delivered you better rates of return. Same thing within an equity portfolio. Holding riskier stocks hasn't given you better returns. It's easy to pick on Canada because there's example after example of high volatility stocks generating no returns. In the healthcare space, cannabis has been extremely volatile, but as of today, hasn't delivered any returns to anyone. If you're lucky enough to time the bottom, buy it, first when marijuana stocks came out, sell it at the top, great for you, but generally that's not the situation. Most people are still buying at the top, and then marijuana stocks sell 70 to 80%. Valiant was another good example. Briac, the energy sector, the material sector has been extremely volatile. It actually represents about 50% of the risk of the TSX, but has generated very, very little returns over the past 10, 20, 30 years, as opposed to, let's say, Canadian banks who weathered the financial crisis very well, who have a strong dividend yield, very low volatility, very well managed, and have generated sort of outsized returns relative to most other sectors or industries across the world over the past 20, 30 years. So these are live examples of holding something that is risky, really hasn't paid off historically. Another way to look at page 9 and 10 is page 11. So holding an actual portfolio that has different levels of risk, what do you expect? So this is really just a compounding effect. If you have the same 6% annualized return with zero volatility, so one portfolio that generates 6% a year, every year, so let's say 50 basis points a month, so straight line up, you generate about $320 after 20 years. With a portfolio that has an expected annual return of 6, so some years it makes 10, some years it makes 4, some years it makes 20, some years it makes minus 20, you generate less money after 20 years. So this is just the effect of compounding and the fact that when you lose money, you actually have to make more money to make it back. So volatility lowers long-term returns. And finally, looking at sort of the premise for the strategy and a real-life back test, so seeing if the strategy is actually implementable. On page 12, we took a real-live index and looked over the past 23 years, 5 portfolios. So we bucketed the index into 5 different portfolios. First portfolio has simply the lowest volatility stocks, and the 5th portfolio has the highest volatility stocks. And we just took these portfolios and simulated the returns over the past 24 years, and we looked at the returns of these portfolios. And then once again, this confirmed that in global, and we did the same test in the US over various time horizons, it's downward sloping, meaning the lowest risk portfolios generated the highest returns, the highest risk portfolios generated the lowest returns. Furthermore, the lowest risk portfolio has a volatility of around 10%, so a Sharpe ratio of return divided by volatility of around 1. But the highest risk portfolio has a volatility of 20. So it has a Sharpe ratio of 0.25. So, you can say, well, maybe I don't care about volatility because my clients, trust me, they'll look at the portfolio in 20 years and maybe they won't care about the drawdowns. But here it shows you, even if you wait 20 years, the highest risky portfolio, the most aggressive portfolios generate less returns. And the fact of the matter is your clients probably do look at the portfolios on a quarterly or annual basis, and they probably don't want to see the 20, 30, 40% losses in the portfolio because they'll get very emotional with that. So you really want to protect capital, and that's what really is the goal of our strategy. Turning to page 13, we have on the y-axis, or the horizontal axis, the horizontal axis is the risk, and the vertical axis is the returns. So if we take a typical cap-weighted index on the TSX or S&P 500, we have one goal, and that one goal is to lower volatility. When you're looking at various managers around the world in the active space, they have one goal, and that's to beat their benchmark. There's been numerous studies that it's nearly impossible to beat the benchmark every year. The top tier managers 1 year, and the bottom tier the next year, and after fees, it sort of all washes out, and you don't get great performance. We, on the other hand, have a completely different objective, and simply to lower the volatility of the portfolio as much as possible. And this leads to very similar returns as the benchmark with much lower risk. And when you combine these two aspects, you get a much better Sharpe ratio, so much better client investment experience. The client has less drawdowns. When markets are up, he's happy. When markets are down, he's not too panicked because we're down less. So we can see this on the next page. So on page 14 is our global fund. The green bars are the fund quarterly returns. The black bar is a benchmark quarterly return. And the main point here is that when the index is meaningfully down, not down 1%, 2%, but down 5, 10, 20%, you can see that the green bars are down much less. So in 2010, 2011, which is a European financial crisis, we easily beat the benchmark, even generating positive returns in Q3 2011. During the oil crisis, when markets were down 7%, we were only down 2 to 3%. During the fourth quarter of 2018, when markets were down 10, we were down 5. So whenever your client or the clients do look at their portfolios, they see that they're down a lot less in the markets. And let's face it, when the markets are up, it's not a free lunch. We're not beating the markets when the markets are up. We tend to lag a little bit, maybe 1% every 6 months, 2%, 2 3% per year, when markets are strongly up. But when markets are up, I tend to cover institutional clients. When markets are up, the client already tends to be happy. He has a job, everything is going well. House price is probably going up. So generally their life is going, financially is going quite well. So they don't tend to care whether they're up 20% or 18 or 17%, as long as a whole they're up. What they really care is when they're down. If there's a recession, markets are down, they lose their job, they don't want to get hit, on sort of 3 or 4 financial aspects all at once. And that's why, our negative correlation to when markets are down is really one of our best selling points, and it's something that we have demonstrated in our funds over the past 10 years. Incidentally, it's our 10-year anniversary, this month. So it's been a good ride since inception of the funds. Even though markets are all-time high now, there's been no recession over the past 10 years. We've still delivered on our promise in terms of expected returns and lower volatility. Turning to page 15, this is just a more concrete example of what happened in 2019. So markets were strongly up, one of the best years in many, many years, and we managed to capture a healthy part of that upside. So the markets were up 23, we're up 18%. We lagged the market a little bit, but once again, when you're up 18%, I think everyone is happy with that type of return, especially after seeing how much capital we protected on the downside. So we just wanted to show that, even though markets were strongly up, we're still able to maintain a high, we call it upside capture ratio. Now let's look at, we looked at graphs before, but let's look at the numbers more precisely to see what kind of returns we've actually been able to generate. So you can compare us against our benchmark. On page 16, we'll start on the right. The inception dates of our Low-Vol Global Fund in 2009, our U.S. Fund in 2014, and our emerging market fund. We'll talk about emerging markets after. But in the developed world in global or low-vol or in the U.S., since inception, we beat the benchmark by 1.6 in global, by 1.9 in the U.S. So we've had lower volatility, 25% lower volatility than the benchmark, and we beat the returns of the benchmark. So that's not something you see very commonly in the active management space. But you can also notice that we lagged the benchmark over the past year. If we take, for example, in the U.S., we underperformed by 2%. Once again, the S&P 1500 is up nearly 24%. We're up, nearly 22%. So 22% gain is, extremely good in absolute terms over the year. So last year we think was a very, very good year across our global and U.S. mandates. Because we still try to achieve, market-like returns over a market cycle, but when markets are all-time high, it's been essentially one big easing cycle over the past 10 years. So we're well within our expectations in terms of returns. Where we're more disappointed is in emerging market funds. In the SSQ product, they hold the emerging market fund. It's a very small allocation. The bulk of the assets are in the U.S. and global. Bulk of global assets around the world are also in these two types of strategies. Emerging markets tend to be bought for diversification and sort of more market return basis. But even the benchmark hasn't done particularly well over the past 5 years, and we've underperformed. And there's multiple reasons for this. We can explain it in terms of Chinese stocks being included in the benchmark, technology driving the benchmark, very large valuation gaps occurring. So we're not happy. We're trying very hard. A bulk of the research done by the research part of the team is looking at emerging markets this year. And we're definitely going to put a lot of emphasis in trying to improve the strategy in the coming years. We did not underperform or outperform any of our competitors in the EM low volatility space. So pretty much everyone that's doing emerging market low vol has struggled over the past few years. But like I said, it's a small part of the allocation. The rest of the book, as you can see, since inception over the past 5 years, we've done very well. Turning to page 17 now, these are the characteristics of the fund. So hopefully you realize by now that by looking at the first column, we have less volatility than the benchmark. That's the first, after the good performance since inception is having lower volatility. So we delivered on our goal of generating 22% less volatility than the benchmark. So when you're looking at the Sharpe ratios of our global fund and our U.S. fund, it's much stronger than the benchmark. So we have a much better investment experience than investing in a passive fund than investing in our benchmark. Followed that with a stronger dividend yield than the benchmark. And finally, we're cheaper than the benchmark. So about 3.7 points cheaper in the global space, about 40 basis points cheaper in the U.S. space. And what I wanted to refer back to when we're looking at the strong market rally of 2019, a lot of that can be explained by strong PE growth. Actually, the earnings per share of the U.S. market was actually flat last year. And so the entire rally was driven by growth in the price-earnings ratio. So us having a lower price-earnings ratio right now is meaning we're better positioned going into 2020 because price-earnings ratio can't increase forever. It's a mean reversion. The last time PE ratios were this expensive was right before the Q4 2018 crash, right before the financial crisis and during the dot-com boom. So that's when we're reading in the news that markets are all-time high, markets are very expensive, and sort of you see here a PE of 25 for the S&P 1500 is high. We're a little bit lower than that, but in the global space, we're a fair amount lower than the benchmark. So we feel we're better positioned going to 2020 to be in a more defensive strategy after such a strong rally of 2020. There's a lot of geopolitical risk coming up, such as the election, still uncertainty around trade wars with China, and finally the coronavirus in China can have widespread repercussions on sales and travel abroad. So this definitely could have an impact on the markets going to 2020. Turning to page 18, this is how we build our portfolios. So to build our portfolios, we essentially rely on two measures, and those are the two on the left. It's stock risk and correlation. Stock risk is very easy. It's a historical volatility of stock. Anyone can calculate that. So in our portfolio, we'll tend to find the least risky stocks. And the second one is correlation. So how the stocks move together. And the best examples of this is, once again, the lowest volatility stocks in the world right now for Canadian investor is a telecom, is a Canadian telecom, BCE, TELUS, Rogers. These are near oligopolies in Canada. They have a lot of, we all know we pay a lot on for internet. Our cell bills are among the highest in the world. So these companies, actually, we wrote an article on this, are the least volatile in the world. As an example, while marijuana stocks, materials and energy have become extremely volatile. So what would you expect in our portfolio? By looking at page 19, this is our global portfolio. The least volatile in the global space as a whole sector is the financials. So the global insurance, namely the insurance companies, are the least volatile, followed by industrials. The Canadian telecoms actually fall in this communication services, but in the communication services bucket, we hold a lot of the telecoms there. But as a whole, the financials is the biggest sector in all of our indices. It's the biggest sector in most of our funds now. It's pretty much the least volatile across the board. Another point here is when you're looking at information technology. So when I showed you the U.S. performance, we lagged the benchmark by about 2%. That is without holding almost any IT. So here IT is about 17. We hold about 4% in the global. So it's a huge part of the benchmark. Information technology, if you can believe, in 2019 rallied about 50% versus the benchmark at 23, and the rest of the sectors around 24. So IT had a huge year, and we still managed to pretty much have the same performance by holding a much more diversified portfolio of low volatility stocks. And that's why we were extremely happy with our performance. A third point is on our sector exposure. So we have limits in terms of sector exposure that's capped at 20%. And you can see that we're more diversified across every single sector. The benchmark is concentrated in IT, healthcare, and financials. We hold more industrials, more consumer staples, more utilities, more real estate, a little bit more materials here. The materials we tend to hold are more in the global space, more of the painters and chemical companies, not the gold and silver companies. So we're a lot more diversified by sector. You can see on the left, we're a little bit underweight the U.S. and by consequent, overweight the rest of the world. And really, the idea behind the U.S. underweight is underweight the technology. So turning to page 20 and re-emphasizing the diversification effect, as you can see, our fund weight is 1.45. That's our biggest holding. So you shouldn't expect in a low volatility portfolio to have huge positions because we try to be honest with our clients, honest with us. We don't want to take huge bets. We can't foresee every type of risk, so we want to limit the number of risks possible. So we cap sectors, we cap countries, we cap single name positions. So we really rely on diversification to create a low volatility. On the top, you see our number of holdings. So we have less holdings in the benchmark because we don't need 1,500 stocks to generate a low portfolio. We only need 260. Here you see our PE, once again, is lower than the benchmark and our yield is. Turning the page to page 21, this is our U.S. fund. So our U.S. fund is concentrated, has more utilities, financials, and real estate, so a lot more defensively positioned, once again, than the benchmark, which has IT. So it's quite impressive that we have almost polar opposite weights of the benchmark of utilities and IT, and we had very similar performance in 2019 while having 20% less volatility. So what's really the point is what we tell investors. What's the point of owning expensive volatility technology firms if you're doing as well with boring domestic utilities, real estate, and financials? Turning to page 22 is the characteristics of our U.S. funds. Once again, it's pretty much the same highlights as our global fund. And so I'd rather open it up to questions at this point than going through the funds in more detail, because all the funds represent the same philosophy of having a low volatility portfolio and really relying on diversification to generate lower volatility with benchmark-like.
Great. Well, thank you, Philippe. So we'll now proceed to answer some of your questions. First question that we received is, what is your opinion on the current stock market valuations and more specifically the technology sector?
Yeah, so we all know that WeWork was a huge debacle last year. How do you go from a private equity valuation of 80 billion, 60 billion to 40 billion? No one writes about it. I guess maybe it's worth zero now. So these unicorn IPOs that were supposed to come out last year and failed was because the valuations are way too high. Apple went from a value stock at 10, valuation of 10 PE to 21 PE. Apple's earnings per share in the Ford space, so Ford earnings per share last year was flat and the stock was up, I don't know, like 80%. Tesla is the most valuable car company in the world. It's great if you own these stocks and you rode the wave. That's a great call on your part. But if you have to actually buy now, instead of I have to sell my fixed income, the yields are too low, I want to get into equities, that's fine. But you'll be buying extremely valuable, extremely expensive, technology sector. And we think that's going to fall back down to normal levels because earnings, we don't see earnings growth growing enough to justify these PEs. Another way is to look at it is everything is sort of priced to perfection for the stock market now. So we don't see how returns can be driven by further PE expansions in 2020. So it's expensive. It's better to buy a more, a cheaper portfolio today and sort of reduce your weight in the technology sector.
Okay, thank you. And what are your views on interest rates for the future?
We're in the camp of lower for longer. We were in the camp of lower for longer when yields were at 1, when yields were at 3, when yields fell back down to 1.7. Inflation is pretty much where the central banks want them to be in North America. Inflation is still quite weak in Europe, in Japan. There's more of an easing bias. Yes, wage inflation is high, but we foresee rates to remain low. That's from just an economics perspective. From a supply-demand perspective, we still see a large demand from pensions and large allocators for fixed income assets. You see a lot of people moving into infrastructure projects and real estate, mortgages, etc. So there's a huge demand for fixed income assets, and that's another reason why yields are more likely to stay low this year. And the third is the political factor. What drives, I guess, the global yield or U.S. yields is what's happening in the U.S. and with an election year coming up, a lot of uncertainties. The Fed's supposed to be independent. Not that they're going to lower rates because Trump wants them to lower rates, even though they sort of seem to follow a few months later. They're probably going to try controlling longer-term rates this year because of perceived uncertainty around the elections. And that's actually another risk spot is the elections for technology sector. If Democrats, let's say they have a miracle win, that'd be a huge revaluation downwards for the FANG stocks.
Okay, well, thank you, Louis-Philippe. There's no more questions at this time, so we'll conclude the presentation. To all of you who listened to the webinar, thank you for your participation, and come back in April for the next webinar. Before we leave, please note that your UFC credit will be sent to you by email in the coming weeks. So thanks again, and have a good day.